Hey, it's Dave Chilton, the Wealthy Barber and former Dragon on Dragon's Den. Welcome to the Wealthy Barber Podcast, where we'll be hosting some of the top minds in the world of personal finance. Yes, that's to balance me out. The podcast is about making the subject not just easy to understand, but dare I say, even fun, honest. Whether you're trying to fund your retirement, figure out how to build a down payment, save for your kids' education, manage debts, whatever, we'll be here to help you do it. Before we jump in, a quick but important note: nothing we discuss here should be taken as investment advice. We don't know you and your personal financial situation, so we're not here to tell you where specifically to put your investment dollars. We're here to educate, get you thinking, and we hope entertain. But please do your own research and/or consult with your financial advisor before taking any action. Hey, it's Dave Chilton, the Wealthy Barber with the Wealthy Barber Podcast. We're on episode number, I have no idea. Okay, I have no idea what episode, but I know it's going to be good because I'm here with Dan Bortolotti. A lot of you know him as the Canadian couch potato. When I first heard that brand, I thought the guy was lazy and basically just describing how he sat around, did nothing, and added no value to society. Turns out I was wrong. It was something
you were absolutely correct.
I was absolutely correct there too. He was describing his approach to investing, and we'll get to that in a few minutes. Dan's an interesting guy. He graduated from University of Waterloo in arts and English. A lot of people, by the way, who've gone on to be very impactful in finance have an arts background. That is a very common theme you see in finance. A lot of times, by the way, it leads to strong communication skills, and that's such a big part of what we do. So we'll talk a little bit about that. He wrote 2 nonfiction books back in the day. What were the titles of the books, Dan?
So the first one was called Hope in Hell, which was basically a biography of Doctors Without Borders, the humanitarian aid group. And the second one was called Wild Blue, and it was a natural history of the blue whale.
Very interesting. So your background's a little science-oriented, obviously.
My interests are, I don't have any educational background in science, but it's something that I read a lot about and enjoy learning about.
Okay, well, how did you go from that to being an investment expert? Let's start there.
Yeah, so it was a bit of an unusual path, I think. But when I came out of school, I started my career as a journalist. But I was a generalist, right? I wrote about a lot of different topics. I worked for several different magazines. And as you can tell from like the books, I didn't really have a specialty in any specific subject matter. But towards the end of my journalism career, I did start to write more and more about personal finance, specifically for Money Sense magazine, which is where I really got my start writing about. Again, it was mostly sort of generic personal finance. It wasn't about investing specifically. But it was around 2008, I started to get interested in the idea of what Money Sense called the couch potato strategy. I didn't invent the term.
Interesting.
And it was, this idea of low-cost investing with index funds. And I think for a lot of people, it seemed kind of counterintuitive. I didn't really understand, what do you mean, by not picking stocks or timing the market, you're likely to do better than most of professional money managers. So I got interested in the idea. I started reading more and more about it. And as you know, the best way to learn about something is to write about it because it forces you to crystallize your thoughts and articulate yourself and forces you to really clarify ideas that you don't necessarily understand. And so I really enjoyed that. I started writing about it for Money Sense. I created the blog just during the Christmas holidays in 2009 just for fun. Had no idea where it would go. And within a couple of years, I had built a bit of a following for people who, that idea resonated. And long story short, within a few years, I just decided to make the leap from writing about investing to actually working directly with clients. And that's when I joined PWL in 2013.
You have a great skill. I started reading your material in 2010, and you actually know that because I reached out and chatted with you. I was going to mention you favorably in the Wealthy Barber Returns. And I loved how you were able to make things understandable. You didn't use stories, really, despite your background in writing. You didn't use a ton of humor. You just had a great ability to make things understandable. And one of the things I think you did extremely effectively was you would take questions from your blog audience that were set you up for responses that could educate the masses, not just the person answering the question. In fact, I think that was your greatest skill. The way you responded to questions pulled people in. I learned from reading them, and I'm in the field. So that was the place you focused. And I think blog writers in general tend to do that quite well.
Yeah, I think it's true. I mean, I'm not really kind of a storyteller. I feel like my skill, if I have one, is to take a relatively complex topic and explain it in plain English in a way that people will understand and be able to integrate it into their lives. And, I think that's what I try to do every day as an advisor now, right? Is, personal finance and investing is complicated and it's confusing for a lot of clients. And many clients find the whole discussion alienating. So, my goal is to try to distill the most important things, get a sense of what's important to the client, and explain just enough to them that they feel confident in the strategy and what we're doing together. And it's not about dumbing it down, and it's not about talking down to people. It's about talking to them just in plain English about something that if every client we have has some expertise in something else that I know nothing about. And
Right.
I'm sure that if they were in the different position, if they were trying to explain it to me, that's how they would do it. And so it's worked very well. I think people find it comforting. And when you're comfortable with your investment strategy, you're much more likely to stick with it over the long term.
Dan, do not be afraid to talk down to me at any time. Okay, people do it all the time.
All right.
I'm used to it. I enjoy it. So yeah, speak down to me for sure. Now, is it true that Bortolotti is Italian for passive? That it means passive in Italy? Is that true?
It is not true, alas. I wish it was, though. Yeah.
I think, by the way, looking at you, you look like a guy who would be an expert in index funds. You are central casting. You just have, that guy knows what he's talking about.
I'm not going to ask you to elaborate on that. Okay.
No, it's positive. It's positive.
Okay.
So let's go back. First off, tell the audience, what is an index fund? So we're taking what's known as a passive approach. We're buying index funds. What is an index fund?
Yeah. So an index fund, I mean, it's just any kind of either mutual fund or exchange traded fund that holds a portfolio of securities, right? Typically stocks, also bonds though, however. But the key idea is that most investment funds traditionally are made up of stocks that are chosen by a manager. And usually chosen because that manager believes that they will outperform the market in general. So it's essentially a basket of stock picks, hand-picked companies. An index fund, by contrast, the idea is to purchase virtually all of the companies in a given market. So if we use a simple example, like in the Canadian market, the traditional index is the S&P TSX Composite Index, which holds several hundred stocks, all weighted by the size of the company. So the biggest companies get the biggest weight in the index. Now, a traditional fund might pick 20 or 30 stocks from that selection because the manager believes that those are going to be the best performers. An index fund, however, would just buy all of them and buy all of them in the same proportion that they exist in the index. And what that does is it allows the investor in the index fund to essentially achieve the return of the overall market. No more, no less, right? A little bit less after fees, but this is the other part, is because you're not paying a high price manager to pick individual stocks, the index fund typically has very low fees, certainly the lowest in the industry compared with other investment types. And therefore, you're going to get almost everything that the market has to offer minus only the smallest fee.
So when you look at index funds, and let's go back over the last 5 years, 10 years, 20 years, you can use rolling periods, whatever. What percentage of actively managed funds, to use your words, funds that are trying to outperform, they're trying to pick the best 20, the best 30, what percentage of those funds have outperformed the broad market averages approximately?
Yeah, I mean, once you go out to about 10 years or so, I mean, it's rare for that number to be higher than about 5%.
Exactly.
And in some cases, it's even lower than that.
I mean, there's some 20-year periods where it's close to 0%.
Yeah. Oh, if you go out to 20 or 30 years, it's statistically indistinguishable from zero, as they say. Perhaps not actually zero. Yeah.
I will ask you the same question I asked your colleague, Ben Felix, one of my favorites. We had Ben on the show as well, and brilliant guy. I was joking with you before we went on that I think a lot of the papers Ben cites, he's making them up. Like he'll say, yes, well, in the Harvard paper of 1978 by Wilson, Johnson, and Kenny, you'll find that they support my argument very well. He knows we won't check. Like I'm going to get on that one day when I'm not busy, although I'm not busy most days, so maybe I'll get on that tomorrow. But I asked him this question I'm about to ask you. Why can't these very smart, very, very well-educated managers with tremendous access to resources and talent, why can't they outperform? Why can't they find the 20 or 30 stocks that are likely to outperform the broad market averages?
Well, that's the great intuitive question, right? And that's the resistance I think that most investors have. It's like, what are you telling me that, this great manager can't outperform a simple index fund? Like, how can that be possible? But when you think about it, it's actually the logical consequence of what happens when the market is full of very smart people like that.
That's right.
So it's called the paradox of skill. So, if you look at somebody like Warren Buffett, people talk about what a great manager he is, and he is. He's a genius. But even he would admit that most of the outperformance that he was able to achieve in his investing career came decades ago when he was by far the best person out there at that skill. Today, we have so many people who have high-speed computers and algorithms and all of the resources you could possibly muster to try to get an edge. And when thousands of people have that and are competing against each other, the chances of any one individual outperforming become remote. So it's not that those managers are not smart or not capable. It's the opposite. It's that there's so many of them who are smart and capable that they can't all outsmart each other.
I couldn't agree more. You said that very well. But beyond that, of course, they've also got to outperform the fee differential. And it's significant. So in Canada, we often have mutual funds charging 2%. You don't see that elsewhere in the world too often. They're closer to 1.25% on average. But let's go with Canada, 2%. As Ben and I discussed, if you're looking at markets that you hope to average 8% going forward, 2% of 8% is 25%. They actually have to be incredibly clever to overcome the drag on that fee. Is that a big part of the problem as well?
Yeah, it's a huge part. And I think that if you look at a lot of well-run active funds, you will see that if the fees were zero, there might actually be some outperformance.
Agreed.
Right? Skill exists. I appreciate that. And there may be ways on the margins that you can very slightly outperform the market before fees. But, if you have an edge that allows you to beat the market by 1%, then you would be, a genius. But if you charge 2%, then all of a sudden you've lagged the market by 1% after fees and you really haven't added any value, because an index fund that you can buy for 5 to 10 basis points will trail the market only by that much and will therefore outperform, your active fund after fees. So fees are a huge part of it. And this is why I think a lot of people, when we look at ETFs, for example, as an investment vehicle that is right for so many people, a lot of them assume that ETFs just in general are excellent products, and they can be, but an ETF that charges 1.5% is not superior to a mutual fund that charges 1.5%. So
no, we'll dive deeper into ETFs in a second, but going back to why it's so difficult to outperform, I would argue there's another reason. Returns are so skewed in the stock market by those few winning stocks. And, we've talked about finding the needle in the haystack. I think I was one of the first people on stage to talk about that analogy and just buy the haystack because it's so hard to find the needles. But what's also difficult is holding the needle the entire time through these incredibly prolonged runs of dramatic outperformance that carry the markets. And even the managers who spotted them and had them in their portfolio have often gotten out too early, understandably so. Taking some profits, being cautious, they're now more highly valued, et cetera. It's just so difficult, again, to keep up to the index because of that type of math.
Yeah, it's for sure. And that's one of the great advantages of a total market index or an index fund that holds virtually every publicly available company, is that you will always hold the next Google, the next Facebook, whatever it is, the next NVIDIA, right?
Right.
And you will also continue to hold them rather than selling them too soon. Now, of course, the other side of that is you will also continue to hold them even if they tank, right?
That's right.
And so I think people who invest in index funds have to appreciate it doesn't protect you on the downside, right?
No.
If the market falls 20%, your index fund is going to fall 20%. And so that is, again, a resistance that a lot of people have. They want to enjoy all of the upside, but less downside.
Yeah, that's what I want. Can you help me with that?
I can help you with that. Yeah, I wish I could, right? So again, it's just really about expectations. But you do make a good point in the sense that when you hold an index fund and once you embrace the strategy, you just get out of this mindset that my goal as an investor is to get in at the right time and get out at the right time, and to find the right company on its way up and then to get out of it on the way down. So once you get those behavioral problems aside and you focus just on the long term, that has a lot of advantages as well.
Oh, I mean, I've mentioned many times, my father is great at that. He, in part of his portfolio has these index funds. He never looks at them. So he never gets emotionally engaged and gets panicked at the wrong time. He's outperformed all the professional money managers over extended streaks, and he knows nothing. Yeah. The guy knows nothing about investing, pays zero attention, and he puts up the best performance numbers of anybody I see. And I've often said to people, if you and I take on Michael Jordan in basketball in one-on-one, we're not beating him. But my dad is truly beating the professional money managers. It's just absolutely astounding. And trying to drive that home to people that that's possible is difficult, but more and more people are clicking to it. And as you mentioned, index funds aren't perfect. They don't protect you on the downside, et cetera. Markets are very expensive right now. For example, we could have pullbacks in the next little while. But in the long term, the odds favor that they're going to give you a better performance number than a professionally managed fund. It's that simple.
We all know that over the long term, markets work. And the reason that they don't often work, well, it's not that the markets that don't work, but investors fail over the short term, is because they have that short term focus. And for people, who have personalities like your dad, that's a blessing, right? Because they're just not distracted by all of the things that sink so many investors. I see it in people's group retirement plans, for example, that they start their group RSP, and some of them are very good. They have actually low-cost index funds in there. They put money in every paycheck. They never look at it. It rebalances itself. And then like 15 years later, they look at this group RSP and it's hundreds of thousands of dollars, and they did nothing except save regularly and stay the course. That's not nothing, but it is often perceived as nothing.
But that is a great insight, because I have said for years that you see the proper behavior much more inside group RRSPs and 401ks. They're, for whatever reason, because people know they're retirement oriented, they tend to stay away from them. They're thought of as being, the company partner, et cetera. And they just don't go after them the way they do self-directed or other projects, and they just leave them alone. And the numbers are astonishing. I have a lot of friends who have multi-million-dollar 401ks in the States, from starting in their 20s and 30s, just leaving them alone and investing for growth. So I couldn't agree with you more. Now, you brought up an interesting point. We're getting a little off topic, but in the group RSP business, a lot of funds in Canada, a lot of programs don't have the low-cost index funds available. Is that changing? Are we seeing more brought on board?
I think we're starting to see more. You're right. I mean, years ago, it used to be if you had a group RSP, you had a choice between 4 or 5, overpriced mutual funds from gigantic mutual fund companies, right? Who, and you got the mediocre performance you would expect from that. It's pretty common now to see not only a menu of index funds, which is great if you know how to build a portfolio from scratch, but also these target date index funds, which allow people to just say, okay, I'm planning to retire in 20 years. This is the portfolio that's suggested to me for someone with that time horizon. And it's just a portfolio of index funds. And the idea is that it gets gradually more conservative as you get closer to retirement, but you don't have to take any action. The fund does that itself. And I think the more you can encourage people to save automatically and keep their hands off their portfolio, the better off they're going to be. And I think a group RSP with a target date low-cost index fund like that is one of the best ways to do that.
Completely agree. Okay, I want to go back to something we were talking about, people buying the high-cost funds, et cetera. What's most remarkable to me, whether it's the Delbar research, Morningstar, or my own research, is that people not only underperform the market when they do that, they underperform it by a lot more than the fee. In fact, in often cases, you're talking 400 to 500 basis points underperformance annually over extended timeframes. I think obviously it's because people are picking the exact wrong fund. we tend to get excited about a fund that's posted good recent performance, and that often is setting us up for failure. Regression into the mean sets in. They were in the hot area at the right time. They stick with it, and of course, it takes a major downturn. Do you see that a lot in the research that you come across or in the clients you deal with, et cetera? And does it not kind of stun you how bad the underperformance often is?
Yeah, I mean, it doesn't surprise me anymore because I've been seeing it for so long. But I mean, it's just a natural, reaction that most of us have when we see outsized returns somewhere else, right?
Right.
So we see it with mutual funds, we see it with stocks. If you had, bought and hold a high performing stock for 30 years, it's likely to do incredibly well. But people don't do that. They wait for it to go up. They wait for their brother-in-law to tell them a story about how much money they made. Then they buy it. And by that time, right, it's on its way down and then they bail, right? So it's the same with funds. There are always superstar fund managers who have periods of 3, 4, 5 years of great performance. Usually, as you suggested, because they happen to be in the right sector at the right time, right? If you bought large U.S. technology companies over the last 5 years, you didn't have to be a genius to make a lot of money. And people will pile into those funds. And, I'm not predicting any kind of downturn, but it seems likely that when you buy those funds after a long period of outperformance, you're probably going to end up disappointed.
Yeah, no, it's amazing how often I've seen that. Where I think I had some success in arguing with people who pushed mutual funds was I would say to them, are you recommending the same funds now you were 3, 5, 7 years ago? And to the people's credit, they almost always went, no, I'm not. And that's a good point. They got excited about one at the time, but then that one regressed to the mean, posted underperformance numbers, and now they're into the next hot thing. But it never stays that same fund. It's never because you've got a manager who truly is so wise he or she can outperform the market over an extended time frame.
Yeah, and to be fair to those advisors too, I mean, we all get pressure from clients to, why are you recommending the same fund that you did 5 years ago? And you could say because it's a good fund,
right?
But even we get it with a passive investing strategy. Sometimes clients will just say like, we've been doing the same thing for however long. Is the world is different now? Should we be changing our approach? And we listen to them and we try to address their concerns. But at the end of the day, the answer is usually no, right? I mean, it depends what you mean by doing the same thing. If you mean sticking to a disciplined plan, then yeah, we're doing the same thing, but that's not something to be ashamed of. That's what we're here for.
Do you have some clients who say, I buy into everything you're saying, Dan. I'm going to go index fund with the vast majority of my money, but I want a little excitement. Okay, I want to have some speculative stocks. I want to do a little something that keeps me paying attention, gives me some jazz. Do you have clients say that kind of thing? And if so, do you kind of go with 5 to 10% into that type of thing?
Yeah, so I definitely have a few clients who do that. And I respect that, right? I mean, it's their money and what we do is not very exciting. And if you want a little bit of, excitement in your life, there's probably a way to do it with a different little sort of explore part of your core portfolio.
Right.
I would say you're right, though. I would keep it less than 10%. I mean, 5% might be more appropriate.
I agree.
And you know what? I used to be a little bit more tolerant of it. Like I used to say, hey, if you need to scratch the itch, you might as well do it with 5% of your portfolio instead of your whole life savings. I have, though, over the years, come down a little bit harder on it. And the reason is that I find it's a huge distraction. So, I will sometimes have conversations with investors who only have 5% or so of their portfolio in, crypto or individual stocks, but that's all they want to talk about, right? And I'm like, can we stay focused kind of on your financial plan, something that's actually important? And your speculative investments on the side are fine, but they're just an amusement. They're really not important to your long-term plan. And so if you can do it and have it not distract you from the main game, it's fine. But there is always a danger that it will preoccupy and distract.
I think that's true, but I think that could be a positive in a way too, that it does distract them, makes them less likely to try to time the market or do something silly with 90 to 95% that's invested in long-term index funds, invested properly, to use that expression. So why I've come off it? It's not so much for the same reason as you, is that I've watched so many of my friends do it with the 5, 10, 20%. They've all done poorly. And so after 10, 20, 30 years of watching them do very poorly with the 5 to 20%, I say, no, stop it. You're basically just throwing money away. Now, if you get enough excitement and enough fun from losing that money that you're actually trading it for entertainment more than investing it poorly, then that's fine. But in most cases, that's not the situation. And so I'm very hesitant to let people do that. I do find a lot of younger people, though, feel almost a need to do it. So they're doing relatively well in their 20s and 30s. They have some investment capital. They want a little crypto. They want a little excitement, and that's fine. But again, it's how much and how far do you go? And of course, when you do that at that age, if you do happen to lose it, and so many do, the opportunity cost is so much bigger because you've given up all those years of compounding that money. It could have made a huge difference. So you and I are like-minded on all of this, but we don't seem like fun people. Neither one of us. And so maybe we're coming at this from our own dull, old perspective.
Yeah. It is funny. And I joked about it, in the book that, I've had, met people, let's say, on vacation or something, and you have the usual small talk. What do you do for a living? And I say, I'm an investment advisor. And they're like, oh, what are you buying these days? Right. And I just bought this. And I'm like, yeah, we just buy ETFs. And sometimes we buy GICs if we want to really get exciting. And they look at me and it's like, all right, change the subject, right? Like,
exactly.
I have no stories, right? I have no exciting tales to tell you. But what I do have is a lot of clients who are going to retire comfortably and clients who are already retired comfortably and very happy, in that situation. So, you get your rewards in different ways.
Well, let's take that a step further. Let's look at your business a little bit. So it was PWL Capital. You just recently announced a sale to an American firm, One Digital. You'll be One Digital Canada up here. And it's more of the American model that I see. It's not surprising to me you were picked up by an American firm. So I'm going to give it my best summary and you tell me where I'm wrong. But basically, you're dealing with high net worth individuals. They're coming to you. They're paying you 80 to 100 basis points a year type thing. And you help them to build a portfolio. But much more importantly, you help them with their overall financial plan. Tax planning, estate planning. Are you properly insured? Are you setting aside the desired amounts for your kids' education? It all is taken care of within that 100 basis point, 80 basis point charge. That's the true value add. They may be able to go out and create the portfolio on their own if they're willing to read your book and do a lot of podcast listening, et cetera. But what they probably can't do is the estate planning, the financial planning, et cetera. Do I have that right?
Yeah, I think you're bang on. And it's interesting because a lot of clients who we've talked to after we made the announcement about the acquisition, people say, well, that's interesting that a U.S. firm picked you up. And I said, yeah, it's interesting, but maybe not for the reasons that you think, because I actually would agree that our model, which we're big believers in, this idea that financial planning comes first and investing is a tool that you use in order to accomplish the plan.
So
right?
Well said. Couldn't agree with that more.
But that is not really the dominant model in Canada.
It's
right?
not.
It's much more common in the U.S. And, for all of the issues that we may have with the U.S. financial system, in terms of the advice model that they have created, they're a decade ahead of Canada, right? And have been for a long time.
Yeah, and they have the fiduciary responsibility. But again, you're so right about the U.S. So if I look at my American friends who are well-heeled, I have a lot of normal income American friends too, but let's look at the well-heeled group. They all use the model that you're talking about. Literally every one of them. They're paying somebody anywhere between, again, 60 and 100 basis points to manage their money, give them a holistic financial plan, the insurance needs analysis, the whole shebang. That's how they do it. Any other way would seem odd to them. Like that just, and by the way, a lot of them feel it's quite a good deal. Yeah. So they look at it and they go, you know what, we think that basis point charge for what we're getting back, more tax efficiency because we're not missing things that we would if we were doing it on our own. We're not getting biased. They quite like the structure. I don't hear complaining about it.
Yeah. No, I think you're right. And I think it's very easy for an advisor who does both investment management and financial planning to add value at that fee level. And, our average fee is well below 80 basis points for the record. And it's quite easy for us to add value at that level. The Canadian model is much more likely to go to the bank, talk to someone, who maybe pass the Canadian securities course and not much else, buy an expensive mutual fund, talk to them once a year during RSP season, is that still a thing? And get no planning, right? And then
I agree. Although I would argue a little bit,
Mm.
and I would say that's also the American model for the non-high net worth group.
Okay.
Okay, so in the high net worth group in the States has shifted over to the model you're using, only partially so in Canada. But it's very difficult to really nail a good business model to help people of modest income and modest wealth, because there's a lot of time involvement in developing these financial plans. I think technology is really going to help. Some of the things we're seeing in the AI space, for example, 3 to 5 years from now, everybody may have access to very strong financial planning, including people with less money. So I think that problem goes across the borders. But for well-to-do people, the model you're offering, I think, makes perfect sense.
Yeah, and you've hit on a really important point, and it's something that has, always, I think, been troubling for me, which is that I'm a big believer in what we do, and I know that we're helping our clients, but I also know that we have a minimum portfolio size that is much higher than the average Canadian can afford.
Right.
We are not able to work with everyone. I would love to be able to, help an investor came to us with $100,000, but there's just no model where we can make that work. The fee that we would have to charge you to keep the lights on would not be a good deal for you. But I think that the encouraging thing is, as you said, the technology is improving. The products are better, right? I mean, you can now buy these very low cost balanced ETFs that are really all anybody needs. And this is a mixed blessing. I mean, there's lots of information available for free on how to invest and how to put together a basic financial plan. It is of varying quality. I'm sure you will agree. But the point is, there is excellent information out there if you know where to look. And anybody who is willing to kind of put in a bit of effort into learning it and to doing a little bit of the legwork themselves can build a portfolio and put together a basic financial plan on their own until they've built up enough wealth that it makes sense for them to work with an advisor where they can pay a modest fee and get good value from that.
No, I agree with all of that. That makes perfect sense to me. What do you read for your investment area? Like, I mean, you don't read a lot of the how to pick stock books because you don't believe in that. What are you reading? Are you reading books on economics, for example?
The honest answer is I read a lot, and I almost never read investing books anymore. I feel like I did that for a few years of my life. It was almost the only thing that I read.
Right.
And I've just gotten to the point, it's not that I think I know everything, by the opposite. I realize that no one is ever going to know anything. And the best service that I can provide to clients is not getting smarter about, academic studies or economics or things like that. It's learning to listen to people better, learning to understand what they need, and then relying on the fact that I have the basic skills to implement an investment plan and a financial plan without having to read every new book that comes out. So, I try to read a nice mix of fiction and nonfiction, but mostly it isn't investing
But you still read The Wealthy Barber once a year, just to
I do
keep it top
every
of
year.
mind. Yeah,
I still have
appreciate
my old dog-eared copy that my dad got in 1989.
41.
What year did it come out?
1941. Yeah, 1941. Now, the other thing is you really don't have to read because you work with Ben Felix.
That's
He's
right. I let
essentially
him
a
read.
human library, and you can just say to him, Ben, can you give me an answer on this question? He'll spit it out with 48 supporting documents.
That's right. I just get the AI summary of whatever Ben reads once a week.
Ben is AI.
Yeah.
He's artificial intelligence that's applies
He's
to
genuine
economics,
intelligence.
business, and investing. No, he's a very, very sharp guy. And is he the tallest person you've ever worked with, by the way?
He's the tallest person I know, for sure.
Yeah, I would hope so. I would hope so. All right, now let's get more to the crux of the matter, the index funds. Okay, you sold me. I want to keep my costs down. I don't think I can outperform the market. I want to just take market returns, less a small fee. How do I choose the index fund? How do I choose the asset allocation aspect of it? Do I go all U.S.? Do I go U.S. and Canada? How much bonds? How much stocks? All of this. How do I think through these different things?
Yeah, that's a lot to cover. And I would say that let's start at the top level, like basic portfolio construction. If I'm starting from scratch and I want to build a diversified portfolio, what building blocks do I need? And I would say the easy answer to that is some amount of fixed income. So that's bonds and or GICs. And the rest of the portfolio in stocks with a mix of Canadian, US, and international stocks. Now, the exact proportions of those doesn't really matter, But as a rough rule, 1/3 Canada, 1/3 US, 1/3 international is not a bad starting place. You can certainly tweak that. I'm not going to die on that hill about what's the optimal, but something like that. All US large cap tech stocks, not diversified, right? A mix of Canada, US, and international, that's a diversified equity portfolio. And then on that fixed income, that bond GIC side, the size of that part of the portfolio really depends on your risk tolerance and your ability to deal with volatility. So if you're the type of person that can weather a 30 or 40% decline in your portfolio in 6 months, which should be expected if you're 100% stocks, then great, go 100% stocks. Most people cannot stomach that, and so should dilute that a little bit by adding some more stable fixed income, which just makes the portfolio less volatile. But if you've got those basic ingredients in there, in whatever proportion is suited to you, that's the right starting point. And there are index funds available in all of those asset classes.
Yeah, we'll get to the asset allocation funds in a second. When you look at the group I write for with the Wealthy Barber, I'm rewriting it right now for people in their 20s, 30s, maybe kind of 22 up to 38, just to throw out the numbers. I often push that group to be quite aggressive. They don't have a huge lump sum. Instead, they're saving monthly in their RSP, their TFSA. They can take advantage of dollar cost averaging. I push them to go almost exclusively into stocks, but with all the warnings about the volatility, but reminding them that the volatility can be their friend. At the time, it's gut-wrenching as they see the market fall 30 and 40%, but they're still in their buying on a monthly basis, and hopefully over the very long term, it'll play to their advantage. For that particular group, more or less just starting out, not a big lump sum, do you think being more aggressive like that makes sense?
For sure. It definitely makes more sense. And certainly if you look to the long term, anyone who is more aggressive and is able to withstand those ups and downs with discipline will get rewarded in the vast majority of cases. And I totally agree in theory that if you're, under 30 and you've got a very long time horizon, a 100% equity portfolio is perfectly reasonable. But I would give the caveat that most people overestimate their risk tolerance. So you can ask them, how would it feel if your portfolio declined 30 or 40%? And they would say, well, I wouldn't really be happy about it, but I think I would be okay. And then their portfolio falls 10% and they lose their minds, right? That is quite common, right? The other thing is a lot of times when people will get started in investing, let's say if you were to do it now, well, we've just come off 2 outstanding years in equities. And you look back at those double-digit returns, and you say, well, of course I want to go 100% equities. But think about the people who made that decision in 2007 or, in 2019 and had to go through the COVID crash, as short-lived as that was, or even 2022, right? It's all very well to talk about your risk tolerance. It's the analogy I always use. It's like saying that you've flown in a flight simulator, so therefore you know what it's like to crash a plane, right? It's you don't until. So I would say my usual advice there is start out reasonable. Like you can go 80%, 70% stocks and wait for your first bear market. And once you've lived through your first bear market, and if you were able to do it without, getting off track, then I think you've proven yourself that you can probably go more aggressive.
Well, 2 things on that. One is this goes back to my father. He is so good at this because when the markets go down 10 and 20 and 30%, he doesn't know the markets went down 10 and 20 and 30%. He knows the Tigers lost 4-3 in extra innings, and that upsets him greatly. That puts his panic a level high, but he doesn't know the markets are down, so of course he doesn't panic. But what about the people out there who, to your point, oh my gosh, I can't believe it's down 30%. They are very upset. They are much more emotionally damaged than they thought they would be, but they don't get out. So they stay the course. And I'm finding a lot of younger people are getting better at this. They're thinking, okay, I've got to stay in. And so when you had the gut-wrenching downturn where March 2020, for example, a lot of the younger people I knew didn't get out. They were frustrated. They were a little panicked. They were down, but they didn't get out. So is that okay if you think you have that kind of mentality where, this is going to bug me, but the risk tolerance level is still okay because I'm not going to panic and get out?
Yeah, that's exactly what I mean. Like I don't mean to suggest that you shouldn't have any emotion. I mean, I can tell you March 2020 was one of the longest months of my life because No, and I mean that quite seriously.
For
Like,
sure.
I mean, I was physically sick for some of those days when I'm looking at the markets going down. There was one day, I think it was down about 12%. I thought
I
it was a
remember it well.
mistake, right?
Yeah.
And here I am responsible for the life savings of 100 households. I mean, I take that responsibility very seriously, and I was quite upset about it. But we didn't panic. We
Right.
did the opposite. I mean, we rebalanced during those couple of months.
Good for you.
We were selling bonds and buying stocks, which, our clients were rewarded for that over the long term. But I don't mean to suggest that there's no emotion, because absolutely there is. But the emotion has to be checked, right?
That's right.
And the way you do it is you have a process in place. And so, when we were rebalancing portfolios in the middle of that, do you think my rational brain or my emotional brain was thinking, this sounds like the right thing to do, right? It absolutely wasn't. It was screaming at me not to do this. But I knew that it was the right thing because we had this well-developed process. So if you're a young investor and you went through that and it drove, like, you were upset about it, you were emotional about it, but you didn't do anything, then to me, you've proven that you can withstand that kind of volatility. And yeah, you can probably go more aggressive in the future.
A friend of mine, Pete Black, I'll give him a shout out, called me the day you're talking about where the markets were down 12%. I was concerned. Yeah, we were all locked in our houses at that time. And he called me and said, I've got to sell. Like, I'm a little older. I've got to sell. Are you selling? And I said, honestly, I'm buying a lot of different things today. I'm stepping in and buying a lot. And it really tended to soothe him. He didn't panic and get out. He's never even bought me a lunch, by the way, for helping him. And I mean, I've been a big difference in the guy's life. And then he came to see me last year and I paid for the golf. This tells you about a lot of the friends I have. They're very, very cheap people. Yeah. But yeah, anyway, he didn't panic at that time. But it is tough. You're right. It's gut-wrenching. I think it's worse for you, by the way, even when you're handling other people's money. The guilt and the down feelings are even more dramatic because you're a nice guy and you want to do well by them and you're a little worried about it. But thank heavens you stayed the course, did the rebalancing, because of course, since then, markets have been outstanding.
Yeah, it was interesting because, and I don't want to smugly say that, we knew it would recover as fast as it did, because of course nobody did.
Nobody knew.
But we, when we were doing rebalancing in the spring of 2020, we ended up having to rebalance the other direction before the end of the year because equities recovered so quickly. Everybody was overweighted equities and we were selling what we had just bought to get us back. So, I mean, think long term. If you're able to capitalize on those downturns by rebalancing in a systematic way and then trimming your holdings when they go way overweight, that's a pretty powerful strategy. And it does sort of push back against this idea that index investors or buy and hold investors do nothing, because we do more than nothing. We are, that rebalancing, it's just that it's systematic. It's not based on our sentiment, right?
How did your clients handle it when both bonds and stocks went down simultaneously? That must have been an interesting experience watching the reaction.
Yeah, I take it back when I said March 2020 was the longest month of my life. All of the months in 2022 were actually just as bad, maybe worse. That was a very, very difficult time as well, because we had spent so much time telling people the reason why bonds are in the portfolio is to protect you when stocks go down. And here we were in a period where everything went down, right? And in some cases, I mean, bonds had periods where it was almost double-digit losses. It was just phenomenal. And, I don't know that was definitely a time where we had to say to people, look, what we had in place, definitely appears not to be working. But we also had to say, well, what would have worked? And what realistically could we have done? People will say things like, well, we all knew interest rates were going to go up and bonds were going to suffer. I said, really? We knew bonds or interest rates were going to go up 400 basis points in 18 months? That had never happened before.
Never.
So, you can't protect against everything. But I will say, and I've been having, review meetings with clients just in the last couple of months, and now we're looking back at 3-year returns, which started with that brutal 2022. Right. But then we're followed by 2 really good
outstanding years.
And I said to them, look, you look back at your 3-year return now, and it's pretty much what we had projected for your long-term expected return. Right. And it's just a reminder that if you hang in there during those bad years, they are pretty frequently followed by good years. And if you'd bailed out there and not gone back, think of all of the returns that you would have missed in 2023 and 2024.
Well, and of course, when people do that, they Dave Chilton it. They end up going backing in when the markets are high again because they're so upset at the returns they've missed, and they set themselves up for a downturn. So I agree with everything you're saying.
Yeah.
When you are doing a financial plan for people, what things are you looking at? You're doing estate planning, insurance needs analysis, savings, the whole thing?
Yeah. Now, I mean, I don't want to oversell what we do in the sense that, we're not accountants, we're not, professional estate planners. But yes, we look at all of those pillars. So, the first sort of thing is, what's your cash flow like today? Are you able to meet all of your expenses comfortably? And if not, we need to look at
make some changes.
The different levers that we can push and pull there. And then there's the investing side as well, making sure that clients are saving in their registered accounts every year if they can, and that we project that, by retirement age, they will have enough that their portfolio will be able to sustain them. But that's right. And then we'll look at their different life stage for insurance. If they're young parents, they've got young kids, they need to have a lot of life insurance. If they're older, maybe their kids are no longer dependents, but they have big tax liabilities when they pass. There's other insurance products that we can do that. And on the estate planning front, we just make sure that they have wills in place, powers of attorney. It's pretty surprising how many people don't have those things. Yeah. Or if they do, the will's 20 years old and the person they've named as their executor has passed away before them. And it's like, we really got to get this updated. So
my father had two executors, joint executors, and they were both dead.
So
both gone. And
both,
I said to him, Dad, they're both dead. And he goes, yeah, that's not ideal. That was his expression. It's not ideal.
It's suboptimal.
It's suboptimal for sure. Two dead executors. So you're right. I see it all the time. In fact, I see all kinds of people who don't have powers of attorney. Going back to your insurance comment, I just put a video out a couple weeks ago. I've been helping a lot of younger people with their financial plans lately as I rewrite the book just to stay in touch with what's happening out there. I'm amazed how many younger people are not properly insured and not even close to enough insurance. If they were to die and they left a spouse and two young children with all the debts they have, oh my gosh, they'd be in big trouble. And the funny thing is the insurance not very expensive.
I
set them up to get the proper amount of term. They're healthy. They're non-smokers. They go, that's all it costs. Mm-hmm. And they're not doing it. Crazy.
I think you're right. I think young people might not realize how affordable term life insurance is. I mean, if you're young and healthy, it's an easy decision.
It is.
And, I have a few clients, unfortunately have had like a spouse pass away relatively young, and there was insurance there. And I know like these clients say to me, if you ever need to make the argument, to other clients, tell them about my situation. It's life-changing, right?
It is. And look at the cancer incidence rates among 20 to 40-year-olds, but especially female. They're rising significantly. I mean, you have to be properly insured against those risks. And I was quite disappointed at how often I'm seeing this now. No insurance coverage in a couple instances. A specific example I'm seeing a lot in an area that it's really problematic is successful entrepreneurs. I think successful entrepreneurs are busy and oftentimes don't think all of this through, but they're putting themselves in a very, very tough spot. One of the challenges, I'm switching topics here, is you deal with your client base, whether it's ultra high net worth or I'm dealing with normal income people, but they're a little bit older. Wouldn't it be nice if we knew how long people were going to live? It would make this whole planning process so much easier if I could say to people, I need you to die at 84 or 92 or whatever, then I could lay it out just perfectly.
Yep. People say like, when should I start Canada Pension Plan? I say, well, when are you planning to die? Right.
Exactly.
Because that's the only way the op. Now, I'm being facetious, but the idea is.
No, you're not being facetious. Yeah. You're right. That's the only way you really know the optimal decision.
Yes. So that's and I always try to kind of resist the idea that a financial plan can be optimal. I mean, a financial plan can be excellent or it can be poor. But it's very hard to say with confidence that your plan is optimal. Because you need to know the future. Not only do you need to know when you're going to pass away, which nobody knows, but also just what might happen to you in the future just with your health. You don't have to pass away, but what if you need to sell your home? What if for a younger person, something could happen in your career that could fundamentally change your situation. So, you try to get away from this idea that there's a set and forget optimal plan, because there isn't. The idea is to actively plan every year and just keep revising it. It's that old cliche that the plan is worthless, but the process of planning is invaluable. And it's true. It's not something that you do once and then move on. You got to revisit it constantly.
It's one of the reasons I really push people to spend so much less than they make. It's not just to have the savings, but there's a buffer. There's a safety there if things go wrong, and they so often do go wrong now. And with AI coming, let's be honest, we can't even guess the impact it's going to have on the job market in certain sectors. And I think people have to be aware of those risks over the next 3 to 5 to 10 years and plan accordingly going forward. You're going back to CPP. Ben and I talked about that. In fact, we're going to do a podcast on it at some point soon. I'm of the mind, after looking at it extremely carefully, that the vast majority of people should take it later. And not everybody, but most people should take it later. Are your clients thinking that way, or are they taking it as early as possible, like so many Canadians?
Definitely not as early as possible. So I do think, though, that that's a decision that, is very individual. I mean, just briefly, I would say my starting point in most cases is 65, right? Like, I know that there is a lot of value to deferring to age 70, but I would argue that that is much more likely to be the case for people of kind of moderate income. Maybe this is a kind of group that you're working with more and more. Right. A lot of our clients have some, significant wealth, and their portfolio will be sustainable for their whole lives. And so there's not really that much longevity risk. If they live to be 98, they're still going to be fine.
Their wealth covers them off.
The higher CPP benefit will help, but it's not going to be the difference between them meeting or not meeting their goals. But you do pay a pretty high price to take it before 65. And but I do have clients, again, who if they've retired early and they need the cash flow, and we do then it can make sense, right?
Agree totally.
Yeah.
Are you seeing a lot of your clients giving kids and grandkids money to help them with down payments, et cetera? I'm seeing that over and over again now.
Yeah, very common. And sometimes they can afford it, and other times, honestly, it's almost to their detriment that, we have to have a talk and say, look, I understand your desire to be generous here, but you're putting potentially your own retirement in jeopardy.
Just went through it. Just looked at the math with a colleague of mine. He wanted to give $250,000 to each of his 2 kids to help them with the down payment. I looked at all his math and I said, I think you can do it, but I need you to die at 72. Because otherwise I think this could end up being a big problem. And remember, you're not getting the money back.
Yeah.
And so it's gone. And I think that some people are going a little bit too far right now. I think it's great to help out your kids and grandkids, but you do have to strike a balance with your own needs as you go forward. And of course, retirement, late life retirements ended up being more expensive for a lot of people than they anticipated because of assisted living and everything else.
I think, and this is where a financial plan, is super helpful. I was working with a client in his 80s who had the same sort of thing. He's like, if I give each of my kids a gift, and it was in that ballpark, $250,000 each, can I still have enough for myself? Well, it's pretty easy to do that with a financial plan. You just remove that amount from their accounts and then run the projections again. And if you're still coming up with a 98% success rate, then you can do it. But it is pretty common, like if you're going to do it younger, like he was in his 80s, if you're going to do it in your 60s, well, there's too much uncertainty after that.
Agree.
And if you have the means that you can give your kids an early inheritance, sometimes people will say that. But if you're going to call it an early inheritance, you need to be very confident that when you pass away, your estate's going to be at least that big, right?
No, I completely agree. And your point about the 60s versus the 80s is the pivotal part. Yeah. And so I've seen some grandparents do it because they're so old, it's de-risked. But when somebody does it at age 62, like my colleague, that's why I said to him, you have to die at 72 because otherwise your math isn't going to work out. My father, by the way, is always trying to get money from us. Yeah, he's always reaching out to the grandkids and the
asking
kids
if you have $250,000.
Can you pick me some lunch up? Can you get me this? Can you take me to Florida? This guy's got it figured out. Okay, he's the opposite of everybody else out there. I mean, it's really... Yeah, he's quite the good person when it comes to financial planning. Okay, we'll wrap up. It's been long and very helpful, but I want to go back to your area of specialty, ETFs. The all-in-one ETFs, I get asked about them all the time. When you look at the comments section on our videos, one of the most common things that comes up, people want to know about them. What's your thought?
Well, I'm a huge fan of them. And I think for do-it-yourself investors, it's pretty difficult to beat. And one of the things that I've noticed, like, remember, I've, spent my whole kind of career as a financial journalist talking about the importance of fees. And when I started, no one was listening. And now everybody is so obsessed with fees that I almost feel the pendulum has swung the wrong way.
Right.
And what I used to get all the time when those all-in-one ETFs came out was, but I can just buy the individual components and it's like 9 basis points cheaper.
Right.
Saying, well, okay. I mean, so a couple of things. Do the math on what difference 9 basis points makes over the course of your investing career. It's not nothing.
Right.
But it's probably not going to move the needle very much, right? When we were talking about low fees, I was encouraging people to go from 2.5% to 25 basis points, right? Like 10 times as much. Now we're talking about going from 20 basis points to
10.
to 12,
Yeah, exactly.
or 9. So I guess what I'm getting at is, don't just look at what is the absolute cheapest. Look at what is the best way to manage a portfolio over the long term. And I can assure you, if you buy those individual component ETFs instead of the all-in-one, your portfolio is going to be out of balance very quickly, and you're going to resist rebalancing it, because the last thing anybody wants to do is sell what's done well recently and buy what's done poorly. So don't underestimate the value of the rebalancing mechanism inside those ETFs, because it's hugely valuable from a behavioral perspective and probably worth more than 9 basis points over your investment career.
That answer is exactly what I say on stage.
Excellent.
Exactly. Is that the 9 basis points are easily covered by the fact that balancing is automated, done for you. And the key thing is then it takes out your behavioral challenge, because you're right. None of us wants to rebalance when something's ripping. Yeah. It's just human nature. So I agree. How often do these rebalance? Annually?
I believe it's quarterly that they do it.
Okay.
But the other thing is that, because these funds are so popular, they have inflows all the time. Like new investors are adding new money. So every time new money comes into the ETF, they rebalance on the fly. So they will only actually need to sell anything and buy if the market moves very dramatically, right? So over the course of a normal year, they're probably just rebalancing with those cash inflows, and you're always on target. You don't have any major rebalancing trades.
And when I buy the all-in-one, I can buy, as I'm trying to get, say, 80% stocks, 20% bonds, but also the asset allocation throughout the world. I can set it up that way. I can cover almost everything off that I would want.
Yeah, well, we were talking earlier about, the building blocks of a balanced portfolio, and it was like a globally diversified portfolio of stocks plus bonds. That's what's in there. I forget the number, but it's somewhere in the neighborhood of 20,000 stocks that are in some of these all-in-one ETFs. I mean, try to imagine building a portfolio like that, not even with individual stocks, which is impossible, but even with sort of sector ETFs or these other building blocks. I mean, you get everything. Vanguard estimated, I think at one point, that one of those ETFs represented something like 95% of the investable market in the world. That's a pretty nice slice of the global economy that you can buy for 25 basis points or whatever the fees are now.
I hate sector ETFs, by the way, and I hate them for a very, very straightforward reason. Everybody I know who uses them underperforms. It's that simple. So I don't have any.
What did well last year.
Yeah, like it's just everybody I watch tends to go into the wrong sector at the wrong time. I mean, you just see it repeatedly. All right, last question. This is the biggest challenge of your entire career.
Uh-oh.
I want you to explain to our listening audience, without boring them, U.S. withholding taxes on U.S. index funds, how it affects them, what the proper approach is to minimize the damage. And again, if you bore people, we will slam you. Go.
All right. Well, that's quite a challenge. All right. So the basic idea here is that if you're a Canadian investor and you hold U.S. stocks and those U.S. stocks pay dividends, the U.S. government withholds a portion of those dividends as withholding tax. It's
15%,
typically
right?
15%. That's right. So if, for example, you hold U.S. stocks directly in a taxable account, and let's say they withhold $1,000 in withholding tax, that comes right off the dividend before it's paid to you. Now, if you file your taxes correctly, you can typically claim a foreign tax credit and get it back. So that's the good news. If you hold that U.S. stock in an RRSP, it's exempt from the withholding tax. We have a tax treaty with the U.S. that says any withholding taxes do not apply in retirement accounts. So if you're going to
So
hold
that's
US
RIFs too.
stocks, yes, RSPs, RIFs, LIRAs, all of those associated accounts. If you were to hold those US stocks in a TFSA, that exemption does not apply. That is not considered a retirement account according to the US government. So you pay the withholding tax in the TFSA. And you remember I said if you hold it in a taxable account, you can get the tax credit and recover it. Not the case in the TFSA. You lose it, you never get it back. So that's the basic. It gets a little more complicated when you're buying Canadian ETFs. Because if I buy a Canadian ETF from Vanguard Canada, iShares Canada, and it holds US stocks, that withholding tax is taken off at the fund level, not at you or at your personal level. And so if you hold that ETF in an RSP, remember we said the withholding tax is exempt in the RSP? It's not exempt now because it's withheld at the fund level, and the fund doesn't know that you hold it in an RSP.
Obviously,
So you lose the withholding tax there. So there's an argument for, if your goal is true tax efficiency, to use US listed ETFs in an RRSP, but to use Canadian listed ETFs in a non-registered account, and even in a TFSA, because it doesn't matter either way, right? You're going to lose the withholding tax in the TFSA either way. So
it makes sense. It's interesting. So what's the dividend rate right now in the Standard & Poor's? 1.8, 2% type thing?
That's what I was going to say. I mean, it would be one thing if these stocks were paying 4 or 5% dividend. That 15% is a lot. But yeah, it's less than 2% now. In fact, it's closer to 1% than it is 2%.
Right. So even if it's 1.5 and you lose 15%, so you lose 0.225, 22 basis points. What it really is a slightly higher expense ratio to gain access to the U.S. market. That being said, I still think people should do what you said and manage it in a way that they get rid of it.
Yeah, and that makes a lot of sense. You just have to remember that there are some other costs associated with holding U.S. listed ETFs in your RSP. You typically have to convert your currency from Canadian dollars to U.S. dollars. There's usually a cost involved in that. It's a little more complex. It makes rebalancing more challenging. So it's definitely the most tax efficient strategy if you can pull it off. But if you are layering on a bunch of additional costs in order to do it, you might have outweighed the benefit.
I completely agree. In fact, the darn currency, it kills you when you're moving back and forth in currency. Some of these companies charge 1% to 1.5% every time you do it. Well, or more. And that negates all of the things we just spoke about.
Yeah.
So couldn't agree more.
It's as mutual funds have come down in price, but I think currency conversion fees is the last bastion of unfair fees in the financial industry.
Absolutely agree. No doubt about it. If you were going to talk to the masses and you're saying, okay, what platform should they be looking at to do some of these things? Is it the Wealthsimple, the Quest Trades, the ones you hear the most about?
Yeah, I don't like to endorse kind of any specific one. Usually the advice that I give to people, especially if they're not very comfortable in online investing, like they have never done it before.
Right.
Start with the brokerage that's associated with your bank. Not because I love big bank brokerages, but just because they're mostly decent. And there is something to be said about having your bank account and your investment account in the same place, on the same screen. You can make real-time contributions to your RSP and TFSA. It just simplifies things a little bit. There are also, all the big bank brokerages now are pretty much the same in terms of their pricing. There's no individual one that's dramatically better or worse than the others. There's some differences. But then if you're comfortable with online investing and you want lower costs and you want, especially, for example, zero fee ETF commissions, then you can start to look at some of the other ones, the Quest Trades, the Wealthsimples. The one fear that I have sometimes with online investing platforms is they like to lure you in with zero fee ETFs. And then you have to ask yourself, why is this brokerage offering me a chance to invest my money with zero fees? And their answer is because they were hoping that you will be enticed to make other types of trades where they do earn a lot of money.
Absolutely.
Right. So
Crypto
they want to start
trades and everything else.
Options and all of these other things that they want to lead you into. So if you are very disciplined and you can stick to this idea that I'm going to invest in this low fee brokerage and I'm only going to buy ETFs with no commissions, do it. But just be aware you're probably going to get emails tempting you to do other things.
Couldn't agree more. Dan, you and I didn't disagree on a single thing. That should scare you. Like, I'd probably retire if I were you. I'd say something is off. Like, I'm not doing what I should be doing.
We're both
Dave and
in
I
an
are
echo
complete
chamber here.
agreement.
Yeah.
I'm going to,
Excellent.
by the way, freeze frame this when I watch it back, and I'm going to check out every single book on that bookshelf behind you. I'll learn a lot about you. What are you
There you
reading?
go.
What have you read? Or what do you want us to think you're reading?
That's
You
right.
probably
I
haven't
told you
read
I
those
don't-
books. You just put those out there that look very sharp.
I
Anyway, it
told
was
you,
so nice of you to find the time. We're going to get Mark on the show at some
great.
point as well. I told him we were going to have him on, but I haven't phoned him back. I'm just trying to, make him simmer, wonder if something's gone wrong. Maybe I don't think
Excellent.
highly of him, that kind of thing. But no, you're a great guest. And, one of the things that you should be very proud of is everybody who's ever dealt with you says you're a very nice guy.
Oh, thank you.
Yeah, that's
good
come up
feedback.
over and over again over the years when your name has jumped into conversation. And at the end of the day, that's one of the most important things in life, that you're treating people well. And even when I called you, you were very generous with your time when I first reached out in 2010, and I appreciated it. So thank you so much for coming on, and nothing but the best in the future.
Thank you so much. I appreciate it.